Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, November the 12th, 2025. Pretty quiet session overnight, to be honest. Let's just catch up and see where we are with the Fed, well, at least with the market pricing. And so if we look at the OIS, so the overnight index swaps here, we can see that the market has got the devil's number here, two-thirds chance of a cut. So if you remember, if we go back, a few weeks, that was at sort of a 95% chance of a cut. Now it's gone a little bit higher than a half. So it's kind of oscillating between, sort of a coin toss at 50% and a full cut. And that's going to depend on the data. And now that the US government, it seems, will be opening up sometime in the next few days if the votes go ahead, could get a sort of a slew of data, some of which may be weak or may be strong or may be confusing. Nobody really knows. But what we did get yesterday, we did get the weekly ADP report, and that came in negative, I think, from memory, about minus 12,000. Now, that number, the ADP report, they've changed the methodologies several times. It's a little, not necessarily the most reliable indicator. But having said that, they do seem to be more and more sort of at least anecdotal and some sort of data pieces of evidence that the US labor market is slowing. And definitely the hiring rate is lower, the quit rate is lower. So at this point, it becomes a question of whether, there's less jobs being created, but there's less demand because of a much lower sort of immigration and whether the labor market is stable. But the point is here that the market has repriced in a slightly more dovish way, and that's obviously going to change as we get the data. But if you look further out, going out here to, the 2026 next year, you can see that if we go all the way until, let's say, the Fed meeting at the end of October, we've just got about three cuts priced in. And if you remember, a month or two ago, that was up to four and a half cuts. So the market has definitely repriced, a slightly stronger economy, sticky inflation and unemployment situation, which doesn't necessitate at this point a very sort of interventionist kind of Fed cutting aggressively. But as I say, that could all change, as the data comes in. Although we are getting to the point where Jerome Powell is going to be out of his job in another 4 or 5 months. He's going to start thinking potentially, not to over psychologize things here, but could he start potentially thinking about his legacy? He doesn't need to do Trump any favors, as we know at this point, to pump the markets or pump the economy. And I personally believe that Powell will be quite focused on inflation. He doesn't want to let inflation run up to some sort of crazy 4.5%. So I think it's going to be data dependent, which is a little bit boring. But just looking at the trough rate, so the lowest rate, at this point we're down to about 3%. You can see here just over 3%. So that's where we're at. And if we actually just look, let's have a look at some of the bonds here. We can go to, let's just look at, I just want to look here at, do I have the yields here of the US? So you can see here, if you look at the 2-year yield, you can see that yesterday it did, it sort of came down a little bit, although, sorry, the cash bond market was closed. So it might actually be better to look at the futures, because the cash bond market was closed yesterday for Veterans Day. So if we look here at the ZT, the futures market was open yesterday, and you can see that that pushed up on the back of those weak employment numbers from the ADP. Just taking a little bit of a pause, but that's the 2-year. Look at the 5-year. A similar situation. If we go out to the 10, also see that was quite strong, and the ZB, the 15 to 20 year sort of futures contract, also up. Just taking a pause. So the market is very, very focused on the data. The bond market is just trying to figure out what's going on. Whereas the equity market is generally quite strong. So if we look at the US indices, the reality is that the stock market is not necessarily the economy. There's a huge amount of commentary saying that we're living in a K-shaped economy where, the bottom 45, 40, 50, 60% of people are living sort of paycheck to paycheck sometimes, or month to month, or 2 months to 2 months, and definitely cutting back. There's been a lot of talk about the cutback in discretionary spending from people like Chipotle and McDonald's and all that kind of stuff. Whereas the top, 10 or 20% of income earners seem still to be pretty happy and are using the so-called wealth effect of the stock market and home prices at highs to keep on spending. So we do seem to have this bifurcated sort of economy. And what we can see here, just looking, is that the stock market is still hanging in there okay. Although we did see today a downgrade from some analysts of Oracle debt, so debt for Oracle. And that's interesting because a lot of people are saying that maybe it's the credit markets where we have this enormous amount of capital expenditure happening, 50, 60, 70 billion dollars a year for a lot of companies. And keep in mind, it's interesting that Apple, which hasn't really sort of outlaid a huge amount for CapEx, is now being considered in a slightly more positive light. But a lot of these other companies, like, sort of Oracle, sort of Meta and Microsoft, all these companies, are spending a huge amounts. And it could be in the debt markets that we start to see some of the sort of pushback against that. And so just say keep an eye on that because we saw Oracle being downgraded, Oracle's debt quality being downgraded, I think overnight. So that's something to keep an eye on. But nonetheless, the US stock indices doing quite well. You see the Russell up and actually the Dow breaking almost to new highs. So, nothing, no technical damage at this point. And although it's tempting to think, oh, it's overbought, time to short, we really have to see, I think, cracks in the employment market, signs of, I don't want to say panic, but certainly loosening from the Fed, and signs of unemployment really going up a lot more. And as I said, potentially cracks in the debt market before we see a significant sell-off. But if we look at a couple of other things, we can look at the equal weight, still doing relatively well, trading around highs. You could pick it at, Mag 7 still not doing too badly. And people like to talk about the breadth, and for sure you could look at the percentage of S&P 500 companies over their 50-day moving average, and it's still under 50%. So that's weak. On the other hand, you can look at sort of indices like the Russell 3000 or the S&P, things like that, with the sort of the less quality companies, the lower quality companies, and they're still doing quite well. So you could argue there that the breadth actually is going out to sort of lower quality companies. Now, is that a good or bad thing? I don't know. But it's not only in the top companies that that stocks are being sold, and definitely globally the equities are doing well. I mean, look at this. This is the Euro Stock 600 breaking out to new highs here. Very powerful. There's been some good sort of company reports over there. You can see things like the German DAX, not quite as strong, but doing okay. I mean, at the end of the day, this is trading at the top of the range. In Japan, again, towards the top of the range. Brazil, we've talked about a bit. This is sort of, another big up day. Just a very, very powerful chart here. And even things like, for example, maybe not so much in China, but you look at sort of the Kospi over in Korea, which did have a little just bit of a pause. I think that was just like a technical pullback here. It was bought on the first Fibonacci, like this short-term fib, 38% retracement here, and looks like it's pushing higher again, on the back of strong semiconductors sentiment and trade relief. So the point is that the Kospi are doing well and global equities doing well. If we look up in Canada, see Canada doing well. If we look over in Australia, you can see not quite as good, but still, it's not as though these things are down 20% from their highs. I mean, even something like Australia here, you say, oh, look, it's not great. But if we actually, look at it, I mean, it's down from the highs, 3% off or sort of all-time highs, so to speak. So, let's not get carried away. Basically, global equity doing quite well. As I say, even despite the fact that there are rumors, people are saying that the employment situation in the US and the US economy is slowing, but we still don't have hard data. We have some surveys and we have some patchy data. We really have to see, some serious government data and cumulative data over the next few weeks to get a stronger sense of that. One thing which is interesting is keep an eye on the situation in the UK. We saw some pretty weak data over in the UK yesterday. We saw that the pound, the 10-year ripped higher on that, gapped higher. It's given back a little bit, and there's been sort of rumors overnight that Prime Minister Starmer, there might be sort of a challenge to his leadership, creating some political instability, maybe after the budget, and Chancellor of the Exchequer Reeves under pressure. Is she going to sort of increase taxation and have a bit of an austerity government budget rather? And so therefore, we're seeing just a little bit of pressure, and it's coming out really in the pound. If you look here at the pound versus the US dollar, you can see that the pound here has been trading pretty softly, and again, the last couple of days just sort of pushing down a little bit. It's now underneath its Fibonacci level. If you see here this kind of impulse going back to the 7th of April, you can see that it's tested the 61.8 retrace. That's now 3 times, so kind of like a triple bottom for the technicians, and it looks as though it wants to break lower. And if it does do that, for sure can test down to this 130 and maybe even lower. And that's probably going to coincide with the budget being released in I think it's about a week or so. And we'll see if there's an austerity budget, tax increases, cuts in spending. That's just like sort of, not great for growth. That means the BOE, the chances of the BOE cutting will go up. Remember, it was a fairly close sort of vote, the last meeting, 5-4 on the Monetary Policy Committee. But if we do get that austerity government, could see the British pound here under more pressure. Apart from that, I'm not going to really look at the other currencies. Not a huge amount going on overnight. What is interesting is the energy markets here. We've been seeing. Let's have a look at nat gas. We've been getting, it's coming up to a pretty critical sort of overhead resistance here, about 466. Some of this is on the fact that production has been low, inventory levels have been low, and of course there's been a snap of fairly cold sort of Arctic weather pushing all across the center and east of the US and up into Canada as well, and so that's been a positive here for nat gas. Let's see if those sort of forecasts continue. From what I'm reading, they could dissipate. Some of that freezing cold weather could dissipate over the next week or so. And there's this nat gas here just maybe going to take a pause. That's interesting. On the other hand, oil also taking. Let's just look at the oil spread here. So this is December 25, December 26, and you can see here that it's still trading. You could argue in the last couple of days that the oil spread, the calendar spread here, Z5 to Z6, has gone up a little bit, but it's still trading fairly heavily. And, at this point, if we just look at, let's say, a Fibonacci here, you can see that here it got to the 61.8, and it still hasn't really, beaten the 50%. So this is still, still a fairly heavy market. And although it was looking promising technically, it's quite a crucial point here because you see this sort of big downtrend line here. So oil did break out. It was looking like a bull flag. It did break out. But interesting that at the first serious resistance, which was this downtrend line here, we've had just a bit of a pullback. And so that could just be a little bit of short-term profit taking. It's not as though this upward movement here of the last few days is over. But really for the bulls to get excited here, they're going to have to break decisively above this downtrend line and try and chase some of these. First of all, the first target here would be 62.60, that recent swing high, and then up to this sort of zone up here of about $65. Now, the measured move here, I've just put a Fibonacci extension here. For sure, these are some of the profit targets or the targets, price targets up here, $64.5, $65. So it could get up there. What we are getting, we got the IEA report, so the International Energy Agency. Keep in mind there are three of them, these agency, that already released its sort of oil outlook report. And that was slightly bullish, essentially saying that, they did see oil demand growth. What was scheduled to get today, and this is why I'm mentioning this, is that the EIA, we get the EIA report, which is like the US government report. It's STO, which is the short-term energy outlook. So that's going to give a bit of a sense of where they think oil demand is going to be and energy demand in general. And also later today, I do believe we get the OPEC report. So we get the monthly OPEC report. And keep in mind that in general, over the last few months, these reports, OPEC has been the most bullish, essentially saying that, the production is going up, but there is still steady growth in demand, whereas the IEA and the EIA reports have been a little bit more pessimistic, saying that we're getting in towards a surplus situation and high inventories in 2026. So that could also push the oil market in one way or another. Those two reports we get today, if they're positive and signaling a strong growth or at least some growth into 2026, that would overturn that narrative of weakening growth and increasing inventories and a surplus. And that could be enough for the bulls to, as I say here, take the ball again and kind of push above this downward trend and push a little bit higher. I believe this afternoon as well, we do get the API numbers, the private inventory numbers. So it's interesting. What I want to look at though as well, just in energy, is also gasoline. Gasoline very strong, definitely outperforming the oil, and just in those lower oil prices, we've seen the crack spreads go up a little bit, and it seems as though gasoline demand has outstripped crude oil demand. So that's a positive. Although what I would point out here, just from a technical point of view, it's almost like we have a quadruple top here. So a fairly strong overhead resistance here on the RBOB contract. You see at around about 1.95. Let's call it up towards $2. So that's also a symbolic level. We know that Trump wants gasoline prices to stay on the low side. I don't know if he's going to jawbone it at all. But keep in mind that we have the Saudi Crown Prince, MBS. He's going to be in Washington next week for a lot of talks. There's talks about doing sort of defense deals being signed and whatnot. So that's probably not a moment for too much political theater. I doubt that Trump, even Trump, will want to publicly embarrass or create the Crown Prince or create political controversies about the oil price is too high. But just it's going to be interesting to keep our ears attuned if there are any sort of comments either from MBS, the Saudi Crown Prince, or Trump just about gasoline prices and oil prices in general. We'll keep an eye out for that. I think I'll leave it there, guys. Not a huge amount more to say. Just in the precious metals, having a bit of a pause. Gold just giving back a little bit here. As I say, a little bit of risk on this morning. We have global equity up. You see gold just taking a little bit of a pause. Silver, though, is still quite strong. I don't want to say it's getting overextended, but it's because it's definitely beaten its fib retrace level here. So this is quite strong. Maybe taking a bit of a pause, but basically this is still a bullish chart, and you should not be thinking about shorting this. We would need to see a lot more overextension. And at this point, this is simply a very healthy retrace, which was bought on the Fibonacci retrace levels, and looks as though it may want to at least test the recent high at about 53.5. Not saying it's going to break through there, but for sure it could do that. And if you look actually again at a Fibonacci price extension here, if we go down to this impulse here, definitely the targets are for a new high. We'll see if that happens. We'll see. Okay, I'll leave it there, guys. Have a great day. And I will continue this tomorrow. Thanks very much. Oh, the other thing I meant to say, a lot of Fed speakers today. We have Paulson, Bostich, Williams, Waller, Miran, Collins, and even Secretary Treasury Bessent talking. So we could get some sort of flavor about where a broad sort of spectrum of Fed speakers and how they're thinking about December and the data. We'll keep an eye out for all of that. Okay, take care. Have a great day, and we'll do this again tomorrow. Thank you.